5 signs you should reconsider your auto loan. Are you cruising confidently with an auto loan that fits your financial plan, or are you stuck with terms that could steer you into trouble? In the realm of personal finance, an auto loan should be a tool to help you afford a reliable vehicle, not a burden that derails your budget or long-term goals. A well-chosen loan aligns with your income, offers fair terms, and keeps your financial health intact. However, some borrowers end up with loans that stretch their finances, carry high costs, or trap them in debt, while others spot red flags early and take action to course correct. The difference often lies in 5 key signs, clear warning signals that it's time to reconsider your auto loan. In this article, we're diving into these 5 signs, grounded in financial research and banking expertise, to help you assess your loan and make smarter choices. By the end, you'll know exactly what to watch for, what these signs mean, and, most importantly, how to take control of your auto loan to secure your financial future. Stay with us until the end, because rethinking your auto loan isn't just about saving money, it's about driving toward financial freedom with confidence. Let's hit the road. Sign 1. The loan term exceeds 60 months. One of the most glaring signs you should reconsider your auto loan is if the loan term stretches beyond 60 months, 5 years. A 2023 report by Experian found that longer loan terms, often 72 or 84 months, are increasingly common but risky, as they increase total interest paid and extend the time you're in debt. While long terms lower monthly payments, they can cost thousands more over time and heighten the risk of owing more than the car's worth. Picture Sarah and Tom, both 32, financing $30,000 cars. Sarah opts for a 72-month loan at 5% interest, paying $496 monthly but $5,712 in total interest. Tom chooses a 48-month loan at 4.5%, paying $671 monthly but only $2,208 in interest, saving over $3,500. Sarah's long term strains her finances longer, while Tom's shorter term keeps him on track. A loan term over 60 months doesn't just inflate costs, it delays financial freedom, increases depreciation risks, and ties up your budget. The good news? You can rethink this. Check your loan agreement for the term length. If it's over 60 months, explore refinancing to a 48 or 60-month term, even if it means slightly higher payments. Cut discretionary spending to afford it. Contact your lender or credit union to compare rates. Ask yourself, is your term 60 months or less, or dragging on longer? A shorter term isn't just faster repayment, it's a smarter path to financial stability. Sign 2. Your monthly payment strains your budget. If your monthly car payment is stretching your budget, forcing you to cut essentials or dip into savings, it's a strong sign to reconsider your auto loan. A 2022 guideline from the Consumer Financial Protection Bureau, CFPB, suggests that total debt payments, including auto loans, would not exceed 36% of your gross income to maintain financial health. A payment that pinches your lifestyle indicates your loan is too costly for your income. Imagine Mia and Liam, both 35, earning $5,000 monthly. Mia's $600 car payment, 12% of income, leaves her struggling to cover rent and groceries, causing stress. Liam's $350 payment, 7% of income, fits comfortably, letting him save and spend freely. Mia's strained budget signals a need to rethink her loan, while Liam's manageable payment keeps him financially sound. A budget-straining payment doesn't just limit spending, it risks missed payments, damaged credit, and financial insecurity. The good news? You can ease the burden. Calculate your debt-to-income ratio, divide total monthly debt payments by gross income. If your car payment pushes it above 36%, consider refinancing to lower the rate or extend the term slightly, while staying under 60 months. Alternatively, trade in for a cheaper vehicle. Check your budget. Does your payment feel manageable, or is it a monthly struggle? A comfortable payment isn't just relief, it's the key to a loan that supports your financial goals. If you're finding these insights valuable, please comment number 2 below to let me know you're here. And if you haven't subscribed, consider doing so and turning on notifications to stay updated with more financial wisdom. Sign 3. The interest rate is above market averages. When your auto loan's interest rate is higher than current market averages, it's a clear sign to reconsider your terms. A 2023 report by Bankrate noted that average auto loan rates for new cars were around 6.5% for borrowers with good credit, 720+ score, while rates for used cars averaged 7.5%. Paying significantly above these benchmarks means you're overpaying, draining your wallet over the loan's life. Consider Zoe and Ethan, both 30, financing $25,000 used cars with 60-month loans. Zoe's 10% interest rate costs her $7,947 in interest, while Ethan's 6.5% rate costs $4,974, saving nearly $3,000. Zoe's high rate, secured during a rush deal, signals a need to refinance, while Ethan's market-aligned rate keeps his loan affordable. A high interest rate doesn't just raise costs, it slows debt repayment, diverts money from savings, and limits financial flexibility. The good news? You can shop for better rates. Check your loan's APR and compare it to current averages on sites like Bankrate or NerdWallet. If it's above market, apply to refinance with a credit union or online lender, especially if your credit has improved. Check your rate. Is it at or below market averages, or unnecessarily high? A competitive rate isn't just savings, it's a loan that works for your future. Sign 4. You owe more than the car's value. If you owe more on your auto loan than your car is currently worth, a situation called being upside down or underwater, it's a serious sign to reconsider your loan. A 2021 study by Edmunds found that 33% of car buyers with trade-ins were upside down, often due to long loan terms or low down payments, increasing financial risk if the car is totaled or sold. Think of Ava and Lucas, both 28, who bought $30,000 cars 2 years ago. Ava's car is worth $20,000, but she owes $22,000, leaving her underwater. Lucas, with a larger down payment and shorter term, owes $15,000 on a $20,000 car, staying in the clear. Ava's negative equity signals a risky loan, while Lucas's positive equity keeps him secure. Being underwater doesn't just limit options, it risks financial loss in accidents, complicates trade-ins, and ties you to a depreciating asset. The good news? You can address this. Check your car's value on Kelley Blue Book or Edmunds and compare it to your loan balance. Call your lender or check statements. If upside down, pay extra toward the principal monthly or refinance to a shorter term to close the gap. Ask yourself, do you owe less than your car's worth, or are you underwater? Positive equity isn't just a number, it's a safeguard for your financial health. If you're finding these tips sparking ideas, please comment number 4 below to show you're with me. Subscribing and enabling notifications will keep you in the loop for more financial insights. Sign 5. You didn't shop around for better terms. If you accepted your auto loan without comparing offers from multiple lenders, it's a sign you should reconsider, as you may have missed better rates or terms. A 2022 report by the Federal Reserve noted that borrowers who shop around can save 0.5 to 1% on interest rates, potentially cutting thousands off a loan's cost. Failing to compare traps you with suboptimal deals. Imagine Sophia and Jack, both 33, financing $20,000 cars. Sophia takes the dealer's 7% loan without looking elsewhere, paying $3,324 in interest over 48 months. Jack shops at banks and credit unions, securing a 5% rate, paying $2,364, a $960 savings. Sophia's lack of shopping signals a costly loan, while Jack's diligence keeps his affordable. Not shopping around doesn't just raise costs, it limits options, reduces negotiation power, and risks buyer's remorse. The good news? You can still act. If you didn't compare initially, research refinancing options now. Get quotes from at least 3 lenders, banks, credit unions, online platforms, to find a lower rate or better terms. In the future, pre-qualify before car shopping to know your best offer. Check your process. Did you shop around, or take the first deal? Comparing terms isn't just savvy, it's how you secure a loan that fuels financial success. Final thoughts. Now that you've explored these 5 signs, take a moment to celebrate your commitment to financial wisdom. Are you managing a loan with a term under 60 months, affordable payments, market competitive rates, positive equity, and well-shopped terms, or do some red flags suggest it's time to reconsider? The good news is that these signs, short terms, budget-friendly payments, fair rates, positive equity, and compared offers, are your roadmap to spotting trouble and taking control. A poorly chosen auto loan can strain your budget, inflate costs, and jeopardize your financial goals, but you're smarter than that. Start today. Pick one sign to address, like checking your loan term or getting refinance quotes. Verify your car's value or calculate your debt-to-income ratio. These steps, however small, steer your loan toward affordability and peace of mind. Your financial journey is yours to command. Keep these signs in mind, and you'll drive away from auto loan pitfalls, building a future of stability and freedom.